Okay, today we're going to talk to you about bank acronyms. The banks have so many confusing bank acronyms. The two that I'd like to talk to you about today is LVR and LMI. LVR, loan to value ratio. It's quite a simple formula. It doesn't need to be too complicated, but a loan to value ratio is the amount of equity you have in the property versus the debt that you have in the property. So in a simple analogy, if you've got a property that's worth 500,000 and you've got a deposit of 100,000, then your LVR is 80,000. And that is really the most simple way to look at it. It's just considering the amount of equity that you've got in a property versus the actual debt that you have on the property. So if I can give you an example, so you're a first home buyer, you've been saving your deposit, and most banks generally will need a 5% deposit. So if you look at the LVR, so you've got 5%, you've saved, it's taken you months and months and months of saving, you go to the bank and you got 5%. 5%, you're buying a house that's worth 500,000, your deposit will be 25,000. Now that's a basic 5% analogy, whereas 95% is a loan and 5% is your contribution. Now, so that leads me into LMI, commonly known as lender's mortgage insurance. There's a misconception, I guess, in the industry that lender's mortgage insurance somehow protects the consumer and protects the loans. In the event that you are unable to pay, which is a really bad extreme, then you will be protected. This is not the case. This is a bank insurance which you have to pay for. And it's really unusual because you're ensuring the bank gets their money back. So always remember that lender's mortgage insurance protects the bank. So in the event that you're unable to pay your mortgage, the lender's mortgage insurance premium, the company that underwrites that loan, will then pay the bank if there's any shortfall in selling the property. Lender's mortgage insurance is one of those things that's based on risk. So if you borrow a lot of money and you have less deposit, lender's mortgage insurance gets more expensive. You borrow less money and you have more money in the deal, then lender's mortgage insurance gets cheaper. It's definitely worked on a sliding scale, so it's based on risk. So basically, the higher the risk to the bank, the higher the lender's mortgage insurance premium you as the consumer will pay. Now, most lenders will let you add the lender's mortgage insurance onto the loan amount, which obviously means you don't have to come up with it in cash, but it's certainly one of those things that there's ways and means of using the way that the contribution that you make from a cash perspective can really impact the percentage that you pay in lender's mortgage insurance. The great news is that you don't have to pay lender's mortgage insurance if you've got a 20% deposit. I guess on the flip side to that is that you can still get in the market with less deposit, but you just need to be aware that you possibly will have to pay lender's mortgage insurance. And you know, it's a pretty commonly used product in the market, and a lot of people, rather than waiting to many years to save 20%, will access lender's mortgage insurance. Hi, it's Matt here from Pro West Finance, 0459 836 916, or get me on prowestfs.com.au.